Hello everyone and welcome to my channel, Compliance Lookup. In this video, we will be learn about part 2 of transaction monitoring and reporting. If you have not watched its part first, then watch it first. These topics are essential for financial security and this will be covered in 3 parts. Then we will start Know Your Customer. If you found this video helpful, don't forget to like, share and subscribe for more content on financial compliance regulations and more. Transaction monitoring key concepts and methods. Transaction monitoring is a crucial component of a financial institution's anti-money laundering framework. It involves continuously analyzing customer transactions to detect any unusual or suspicious activity that could indicate money laundering, fraud, or terrorism financing. Below is a breakdown of the key aspects. A. Objective and norms for monitoring. Its objective. The primary goal is to ensure that all transactions conducted through the institution are legitimate and comply with regulatory norms. The institution needs to identify and report any suspicious activity to the appropriate authorities. Now, coming to its norms. Financial institutions must follow regulatory standards set by bodies like the Financial Intelligence Unit and international guidelines such as the Financial Action Task Force recommendations. Example. A bank tracks all transactions and monitors for large or irregular activities, such as sudden high value international wire transfers by a customer who usually conducts only domestic, low value transactions. B. Methods of monitoring. First, observation based monitoring. This method relies on bank employees observing customer behavior, patterns of transactions, and other activities to spot suspicious actions. It is a manual process but useful for detecting patterns that automated systems might miss. Example. A teller notices that a customer frequently deposits large amounts of cash just below the threshold requiring a cash transaction report, triggering suspicion. Second, exception report based monitoring. In this method, the bank system generates reports highlighting exceptions or deviations from a customer's normal transaction behavior. These exceptions might be transactions that exceed preset limits or sudden changes in behavior. Example. A customer usually makes small, local payments but suddenly sends rupees 50 lakh abroad. The system flags this as an exception, generating a report for further review. Third, AML software based monitoring. Most banks use specialized AML software to monitor transactions. This software uses algorithms and rules to flag transactions that deviate from expected norms or raise red flags based on predefined criteria. Example. A bank's AML software detects unusual patterns in transactions from one account, such as sending funds to multiple foreign accounts in a short period, which could indicate layering in money laundering. C. Rules for generation of alerts. First, specific rules for trade-based money laundering (TBML). Trade-based money laundering involves using international trade to move illicit money. The monitoring system generates alerts for specific TBML red flags, such as over-invoicing, under-invoicing, and the use of shell companies in trade. Example. A customer imports goods but the value declared on the invoices seems inflated compared to the market value. This discrepancy could indicate TBML and trigger an alert for further investigation. Second, analysis of alerts. When an alert is triggered, it needs to be analyzed to determine if it warrants further investigation or reporting. This involves reviewing the flagged transaction against the customer's history, business profile, and other known patterns. Example. An alert is triggered when a customer transfers 40 lakh rupees to multiple small accounts. The compliance officer reviews the transaction and the customer's profile to determine if this is legitimate or suspicious. Third, fine tuning of alert generation to reduce false positives and improve the efficiency of monitoring. Systems are fine tuned regularly. 1. Whitelisting. Certain accounts or customers that have been verified as legitimate can be whitelisted, meaning their transactions will no longer trigger alerts unless new suspicious activity occurs. Example, a long-term customer with a clean history is whitelisted after an extensive review of their activities. 2. Rule management. The rules set for the monitoring system need constant updating to keep up with evolving financial crime tactics. Example, the bank adjusts its AML software rules to look out for new money laundering techniques identified by the FATF. 3. Threshold setting. Transaction thresholds that trigger alerts can be adjusted based on the type of customer or risk level to ensure that only truly suspicious transactions are flagged. Example, a bank increases the alert threshold for a low risk corporate customer but lowers it for a customer flagged as high risk. Fourth, advanced technology for transaction monitoring. Advanced technologies like artificial intelligence, machine learning, and data analytics are used to enhance transaction monitoring. These tools analyze vast amounts of data to identify complex patterns that might indicate illegal activities. Example, an AI powered system detects subtle patterns in a customer's transactions that indicate layering, a method used in money laundering to obscure the source of funds. 3. Suspicious Transaction Report STR propositions and approval. First, preparation and filing of STR. Once a suspicious activity is identified, a suspicious transaction report STR must be prepared. This report outlines the transaction details, the reasons it is deemed suspicious, and any other relevant information. The STR is then submitted to the FIU. Steps involved. 1. Transaction review. The bank's compliance team reviews the flagged transactions and evaluates their suspicious nature. 2. Documentation. Detailed information about the customer, transaction history, and the flagged activity is documented. 3. Approval. Senior compliance officers or an internal STR committee review the case and approve the filing of the report. 4. Filing. The STR is submitted electronically to the FIO or relevant authority. Example, a customer tries to wire 25 lakh rupees abroad but cancels the transaction when asked for additional documentation. The bank investigates, finds it suspicious, and prepares an STR, submitting it to the FIU for further action. Coming to its conclusion, transaction monitoring is an essential mechanism for detecting financial crime. Institutions must adopt a multi-layered approach, combining manual observations, exception reports, automated monitoring, and advanced technologies to identify and report suspicious transactions. Fine-tuning alert systems, leveraging AI, and filing suspicious transaction reports in a timely manner ensure compliance and help protect the financial system from illegal activities like money laundering and terrorism financing. Now coming to next, STR typologies. These are patterns or scenarios identified by financial institutions and regulatory authorities that may indicate suspicious or illegal activities such as money laundering, fraud, or terrorism financing. Below is a detailed explanation of various STR typologies based on inland, cross-border, and cybercrime related cases, along with real-world examples. A. Cases with inland transactions. These are suspicious transactions that occur within the same country. First, common remitters shell entities. Shell entities are often used to hide the true ownership or purpose of funds. Example, multiple small businesses controlled by the same owner transfer funds to one another, even though they have no apparent business connection. These funds are then sent to a third party, raising suspicions of money laundering. Second, multiple level marketing MLM related activity. In MLM schemes, participants are recruited to sell product services and earn commissions from the sales of recruits. Such schemes can be used for money laundering. Example: an MLM company that claims to sell health supplements receives large cash deposits from individuals with no clear business rationale. Upon investigation, the bank finds that the deposits are being funneled through various accounts, suggesting potential laundering of proceeds from illegal activities. Third, multiple shell entity. Multiple shell companies are often used in a chain to obscure the origin of funds. Example: funds move between several shell companies registered at the same address, with each transferring money to the next in a complex web of transactions, eventually landing in a personal account. There is no clear business justification for the movement, triggering an STR. Fourth, Benami entity MLM activity. Benami entities are those that hold assets on behalf of another person. They are often used to conceal the true identity of the beneficiary. Example: a series of transactions is detected between an individual and several companies, but the funds appear to be controlled by another person who is not named in the company's ownership documents. The companies are also linked to an MLM scheme suspected of defrauding investors. Fifth, shell entity sudden spurt. A sudden spike in financial activity within an otherwise dormant shell entity raises suspicions. Example: a shell company with no substantial transaction history suddenly starts receiving large transfers from various sources. Upon further inspection, the funds are quickly moved offshore, suggesting money laundering. Sixth, no economic rationale. Transactions that lack a clear economic purpose or justification are often considered suspicious. Example: a customer makes large deposits into an account but doesn't provide any explanation for the inflows, and there's no economic activity. Example: sales or services that would justify such large sums. B. Cases with cross border trade transactions. These involve international trade and can include mispricing, false invoicing, or other tactics to launder money through trade. First, trade based multiple shell entities. Multiple shell companies are used in international trade to disguise illicit funds. Example: a company imports goods but uses different shell companies in various countries to handle invoicing and payments. The goods are significantly over invoiced to shift excess funds to offshore accounts controlled by the original entity, raising suspicions of trade based money laundering. Second, trade remittances, unrelated activities. Funds transferred for trade purposes that don't match the stated nature of the business are a red flag. Example: a company that normally exports agricultural products suddenly receives a large remittance from a foreign buyer for the sale of electronic equipment. The company has no history of dealing in electronics, and the transaction is flagged as suspicious. Third, trade based account closed in short span. Accounts used for trade are often closed soon after receiving large remittances, which may indicate fraudulent activity. Example: a business account opened for a supposed import export company receives several large payments from abroad. Shortly after, the account is emptied and the company ceases operations, leading to an STR for suspected trade based money laundering. C. Cases related to cybercrime and cryptocurrencies. These typologies involve illegal activities like cyber attacks or cryptocurrency fraud. First, ransomware attack on computer systems. Ransomware attacks involve hackers encrypting an organization's data and demanding payment, often in cryptocurrency, to restore access. Example: a company's computer systems are compromised by a ransomware attack. The attackers demand payment in Bitcoin to a wallet located on a foreign exchange. The company transfers the funds, but the suspicious nature of the payment and the connection to known cybercrime patterns prompt an STR. Second, cryptocurrency OneCoin Euro fraud. Cryptocurrency fraud schemes often involve Ponzi or pyramid structures. Example: in the case of the OneCoin fraud, promoters convinced individuals to invest in what was claimed to be a new cryptocurrency. However, OneCoin didn't actually exist on a blockchain. Investors were defrauded of billions, and the transactions associated with OneCoin sales were flagged for STIAs due to their fraudulent nature. Third, cyber attack through SWIFT heist. The SWIFT network is used to transfer international payments between financial institutions. In some high profile cases, cybercriminals have exploited weaknesses in the system to steal funds. Example: in 2016, hackers used the SWIFT network to steal $81 million from the Bangladesh Central Bank. The heist involved malware that intercepted and altered legitimate transfer requests, funneling funds into accounts controlled by the criminals. The unusual nature of the transfers triggered multiple STRs and a subsequent investigation. Now, coming to its conclusion, understanding these STR typologies helps financial institutions detect and report suspicious activities that could indicate money laundering, fraud, or cybercrime. By identifying common patterns, whether inland transactions involving shell companies or complex cross border trade schemes, banks and other entities can better protect the financial system from abuse. So, we have completed this chapter of part 2 of transaction monitoring and reporting. In the next lecture, we will see its parts 3 of transaction monitoring and reporting. If you want to get updates of this topic, then please press bell icon of this channel. Thank you so much for watching this video.